I'm Mark Gagan and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go, enabling an enterprise view of exposure. Today's guest is David Ibeson, the CEO of Apollo Syndicate Management. David is a Lloyd's veteran with over 25 years in the market, 20 of which he has spent in the CEO role at Lloyd's managing agencies. In an era when so many bemoan the lack of strong personalities, David is an exception that proves the rule. David is also another extreme rarity. That's because he's a qualified actuary, but one who is also a born communicator. In this podcast, we examine David's view of the market and Apollo's strategy within it. From our chat, it soon emerges that Apollo is as exceptional as David. That's because whilst Apollo is in many ways quite a traditional Lloyd's business, the risks it is looking to take on and the products it is looking to develop are anything but. Here we discuss everything from Nat Cat appetites to the sharing economy and the prospects for algorithmic underwriting, all with a huge amount of energy and good humour. I had a lot of fun talking to David, and I think you will too. Enjoy the podcast.
Hi, I'm Rick J. Lindsay, Chairman and CEO of Claims Direct Access, otherwise known as CDA. We all read about the claims nightmares in the United States of America, social inflation, nuclear verdicts, and the sky is falling. Hardly a day goes by without the news of reserve strengthening at major carriers. However, it's not all bad news. In the United States of America, we have the best legal system in the world, which allows you to fight frivolous claims and litigation and come out on top. In this kind of environment, you must get smarter about how you handle your claims and who your partners are. You have to move fast and be robust. CDA has been handling claims for over 40 years nationwide and has a team of 46 claims professionals, including 12 highly skilled attorneys and litigators. We have handled cases for major Lloyd syndicates since 1994, as well as U.S.-based major carriers, and have closed over 70,000 claims since 1994 nationwide. Not settling frivolous litigations is a must. CDA claims service means going the extra mile, handling claims quickly and vigorously with a proactive approach. Why not get in contact now to see how CDA can do the same amazing work for you and your partners that they do for me every day? Visit www.claimsdirectaccess.com today.
David, welcome to the Voice of Insurance.
Thank you very much.
Apollo, I think I'd have to make a confession to say that this is a business I've been aware of for a really long time, but I haven't known that much about it. Maybe it's because you've been a small business that's grown. But over the last couple of years, you've really put yourselves out over the parapet. But it's made me feel that I don't know enough about Apollo. So I'm just going to ask you some, at the beginning, I think there's some what might be obvious questions. So forgive me if you think they're a bit obvious. So Apollo's got two main syndicates, 1969 and 1971.
Yes.
Why is it structured that way?
Quite simply because capital providers have different appetites. Some capital providers want specialty lines with property and are happy to have cat exposure. Others are more interested in the developments of the sort of sharing economy and quite happy to back that business. So we offer two syndicates. Capital providers can back both or either. And in addition, it's good branding for clients.
And so 1971's the iBot syndicate, and that's the one that's connected to more of the sharing economy, the internet economy, whatever we want to describe it.
Yep.
Is it partly a sort of risk management thing as well? Is it because it's such some untried risk that you think, well, I don't want to pollute the sort of more standard syndicate that we know that's more tried and tested?
No, not at all.
It's really because of the backers.
It's definitely offering optionality to capital backers.
And obviously the 1971 one would presume, given that those classes of business are exploding in terms of, everyone's delivery riders have just used to have local delivery riders 5 years ago, but now every main street, every high street has got hundreds of them whizzing around delivering all sorts of things. So presumably those are going to be very, very high growth. Do you say 1971 is going to grow faster than 69?
Yes, you can see from the growth that we put in for next year, the growth of the underlying industries that we are backing is significantly higher than the traditional economies.
And just to put a number on that growth, now obviously the business planning's sort of all done.
It's just around 70%.
It's huge. So how much of that is rate and how much of that is new exposure growth?
I would say a majority is actual growth in terms of the underlying businesses. Then we have a small assumption on rate growth on top, and then we've got one new class of business that we're going to be writing for next year.
And that's in 1971, is that?
That's in 1971, that's occupational accident.
So I presume if you're growing at 70%, you must be very happy with the rate adequacy of what's out there in your core classes.
Well, yeah, I mean, that growth of 70% is 1971. 1969, we're growing, or the capacity is growing at 50%. Yeah, every class in terms of rate adequacy we expect to be better next year than it is this year, apart from one, being terror. And despite the losses that we think the market has suffered this year, that is a class that does still have some negative rate movement in the year.
Would you say it's still adequate, though?
Well, clearly we believe it's still adequate because we're writing it.
But it's quite nice that, presumably it's nice to have adequacy and then be a little bit more adequate year after year. I mean,
yes,
this happens so rarely, doesn't this?
It seems to have been quite a while since it's been like this. But I think it'll have to continue for quite a while. Given the results we're seeing in the market, with the cats happening the way they are, I would expect good rate adequacy to last for quite a few years.
Yes, I read, or no, I heard actually in an interview you did recently, you were explaining about you're slightly tempering your cat appetite. So what's behind that? Is it that you just don't want it anymore? You've changed, you don't want to have that volatility in your lives, or is it you're not getting the rate for it, or is the nature of the risk changing? Obviously, climate change, etc. Do you feel that it's just a losing wicket and it's going to get worse?
The way I would think about it is short-term and long-term. From a short-term perspective, clearly the market is challenged. The cat models have failed to pick up the sort of low severity, high frequency, severe convective storms type losses that we're seeing. And we're seeing lots of losses. I think normally you would have expected in a 5-year period for there to be maybe 2 years of sort of large cats and then 3 years of not. Well, I think we're sort of having the last 4 years, it seems to have been that there seemed to have been a reasonable number of cats. So short term, we're probably just looking at it and saying it's not reasonable to assume that it reverts to the long-term mean, whatever that is as an assumption. Long-term, we believe that the market will correct structurally. Question how much can that be dealt with through rate. You get to the point where people don't want to buy it anymore because the price is too high. But we're a specialty insurer and we think property is an important part of that portfolio. But for 2022, we're sort of seeing opportunities in other classes which outstrip those of sort of the property classes with the cat component.
You're not pulling out completely, and also I presume it's a recognition that you're not a big enough player in cat to be able to move the market yourself by doing anything.
I think very few people are big enough players to move the market in cat. No, I think pulling out is the wrong word. I think we've slightly reduced our appetite this year and we are growing all our other classes next year. So what happens is it's slightly shrunk and then it has really significantly shrunk relative to the growth that we're seeing in the rest of our portfolio.
Great. So it's just a bit of rebalancing.
Yes.
Again, and if it were more attractive, you would be trying to do more of it.
Absolutely. And who knows, if we had this conversation a year or two's time, we may be looking at a different situation.
Yeah, we'll see. Obviously, as 1/1 comes up and 1/4, 1/6, 1/7 next year, we'll see what happens, whether the reckoning ever comes. But there's always a tidal wave of capital being kept in reserve that people keep quiet about, it seems to me, doesn't it, in cat?
Maybe. I think the market
they've probably had enough of losing money, haven't they?
I think the market is acknowledging that the models need changing, and that you need different views of risk. And many of the people I've talked to in the market are also saying that it's a stressed market. So I don't see masses of capital coming over the horizon to write lots of cat business.
It's interesting. Again, in a recent interview, I learned about your hybrid model, which again sounds quite traditional in a very traditional Lloyd's model, or traditional for some people. It's a model that other people have taken. So it's your own writing on your own capital, leveraging third-party capital, and then doing ancillary third-party services and what we would have called turnkey. I know you're not a turnkey player because you see value in it, in that managing syndicates for others as a strategic thing. You'd only do it with someone you have a strategic relationship with or want to have a strategic relationship. Within that, Lloyd's has revived the captives idea. What do you think about this captives at Lloyd's? Do you think it's a viable proposition? Because obviously, there are captive domiciles everywhere you look.
The answer is absolutely. Absolutely on various fronts. I was actually at Wellington when we set up the first captive syndicate many years ago.
Because it was about 20 years ago when all the legislation was sort of done, enacted, and there was a trial one, and then that was it, wasn't it?
It was, that's right. But if you think about it in terms of ultimately we need to provide a service to the clients. And if you take the sharing economy as an example, the clients are growing very rapidly. And as they grow and become bigger organisations, they go from sort of, we don't have a lot of information, we really need a lot of protection, through to the point where eventually they in essence want to self-insure. And actually I would say probably the biggest competitor in the sharing economy is self-insurance. So from our perspective, if we can follow that client journey and say, well, actually, when you're starting and you don't have the data, well, we have a big database, so we can actually support you, provide you insurance, and help you grow. Then actually, when they get to the point where they want to self-insure, we can say, well, actually, that's a service, again, that we can provide you as part of the complete package. You know, from our perspective, if we focus on clients and do the right thing by the clients, we think that'll be good for the business.
Excellent. So you're really up for it, and
very much
we
so.
should be watching the space and see if you get one of these over the line at some point.
Yeah.
Oh, excellent. That's really good. I haven't heard. Sometimes people create all these new schemes and things, and you wonder who's actually, is it being driven by actual client demand? And so it's really good to hear that there is. So excellent. We've been talking about a really good market, where price adequacy has come back and it's still improving. At this time, how much do you look upon your book as being opportunistic in a sense, and how much of it is absolutely core that is for through the cycle ups and downs?
I think that's really difficult to estimate. You don't ask an underwriter what would you write at this point and what wouldn't you. I don't think we would be in a class if we thought the class was opportunistic. So we're not going to recruit staff and say let's build the account for the next 3 years and then get out. So as such, not a class being opportunistic, but within a portfolio, underwriters are constantly looking at what works, what doesn't work. Clients move into domestic markets and out of domestic markets, and the underwriters make the judgment as to whether that's an appropriate risk to write. So I don't actually have an estimate as to what percentage would be in or out at any particular point in the cycle. And I think we just look to write the right risks at that time and stick with good clients. So
that it really is just a myth that the great cycle management sort of CEO is saying, yes, when the market gets really tough, I just send the underwriters off to play golf. It's like, I don't think they do. Do they?
No, I don't think they do either.
No, you just wish you'd never been in that class and you just get out of it.
Yeah, no, I think the key, and this is something that we're working on, is how you improve efficiency, how you improve rate analysis, and how you improve client selection, and how you sort of improve client engagement. That way, maybe you can outperform the rest of the market in terms of keeping going longer into the cycle. But rate is either adequate or isn't adequate at the end of the day.
Other than these obviously growing economy, sharing economy, these things that are growing exponentially fast. When you're looking at the market, perhaps in the more traditional side, the traditional lines, where do you see the best opportunities?
Actually, pretty much in the specialty areas. As I said, we're growing across the board. Well, apart from property, which we just discussed. So I think we would say that we think specialty insurance is doing well at the moment, and we're cautious on property.
It must be interesting, obviously, particularly as you're getting into this insure-techy kind of view of risk, and presumably some of these sharing economy risks are the sort of ones where you have policy duration of matter of hours sometimes, not the standard sort of 12 months at kind of stuff that we're used to. So in terms of technologically, what sort of challenge has that been to you? Because obviously you specifically set yourself up to try and do this. So is it something almost disruptive?
I think it evolves to that. Some of the biggest challenge is data ingestion, because there is so much information. It's how you absorb that, analyse it. And the actuaries are constantly, and data scientists are constantly working on ways to crunch the data and use the data for pricing.
Yeah, and so, for example, with that occupational accident, with that, I presume that could be quite dynamic. It's almost one rider's going to be very different from another. And are you getting into almost that dynamic pricing of saying?
Yeah, I think
fast riders who don't wear helmets obviously get different rates.
Well, I think there's lots of risk management that comes into play. It wouldn't be a selective approach. It would be offered across the whole portfolio, so there would be averages, but there is a lot of data that sort of says, yes, these are good risks and bad risks. But then I think ultimately with the company perhaps writing these risks on their balance sheet as well, it's all about trying to minimise accidents rather than just insure them.
So you're not getting to the point where I've seen with some of the insurtechs where you've got your speedometer on the dial and you've got your pay-as-you-go insurance-ometer going, almost correlating with it.
Absolutely. You can see that there will be the point where there are different routes, and depending on the route, there will be a different price.
Obviously, the other big technological sort of themes in Lloyd's of the last 18 months has been development of algorithmic underwriting. Given that you've got the iBot rover and you're in that space, we haven't seen anything publicly announced on that, but I presume this is something that does interest you.
Yeah, I think algorithmic underwriting intellectually interests me. I think it works for homogeneous data sets. I think we are looking at how we can combine scalability and processing power of computers with sort of analysis and client relationships and decision making of quality underwriters. So algorithmic, I think you're probably saying no human involvement. I think we're more augmented, which is computer power plus underwriting power, which we think can be operationally efficient and perhaps deal with some of the more nuanced elements of risk selection.
I was at a conference recently and one of the CEOs on the panel said he was worried about almost these technological tanks being parked on the lawn of the underwriter. And then I was at another panel during that event and someone said, actually, we're kidding ourselves a little bit with specialty, that we think, obviously, some of these risks that we're underwriting are so bespoke, they've got so many different data points. But actually, I had a broker saying, well, you know what, we boil it down to there's actually about 5 that are actually the important ones. So do you think we could get to the point where things that we thought could only be bespoke, human only, could be done by machine?
I don't believe in a world where machine does everything, but I do believe in a world where the machine can improve what human only is doing.
Yeah.
So, yeah, I think for us, the combination of man and machine, and man being man and woman, and machine is probably the way to go. I think some people are overselling the way in which it can all be computerized, and some people are overselling the difficulty of being able to include analysis in the process.
So it's improve the skill of the underwriter, give them everything that they need to make difficult decisions, and productivity, I presume.
Yeah, so split it into 3 blocks, really. One is all the information that's available and how you use that in an efficient way to make good risk decisions. The other is productivity. Can you be clearer on your risk appetite? Can you use sort of ingestion engines to say these are risks that you're more likely to bind? So spend time on the risks that you will write. And then the third element of the sort of augmented underwriting is client engagement, making sure you work with the client and deliver something they want.
And do you think this is going to bode well for the expense ratio ultimately?
Fingers crossed.
Yeah, yes. I presume that some of the ramp-up costs are a bit painful,
But it is more about writing more business that you like at attractive rates rather than reducing costs. So the percentage costs go down, not the actual costs.
And writing 2 good risks is better than writing 2 not very good risks.
Absolutely.
Because it's just much cheaper, isn't it? Because it improves your loss ratio as well, right?
Yes.
Obviously, another big technological change is something because it's almost like a permanent revolution in the London market, certainly throughout my career, my interaction with it, that we've always been some kind of reform, improving the plumbing around London. We're in another really important phase of that at the moment. Some would say a crucial phase. It's difficult to say make or break because we've not always done it and it hasn't always broken before. But, it is a particularly important phase at the moment. Do you think everything's going fine and is it going fast enough?
I think you can always point to things that you'd like to go faster, and you can always find fault in things. I would say that the London market and Lloyd's have always sort of delivered when they've had to in the end. And so I think the reform will happen, but as always, it will be painful.
Presumably you don't think you've got a better way of doing it yourself?
No.
And you're kind of grateful that someone else is doing it?
Absolutely, I'm very grateful for the Lloyd's market.
But yes, you just got that frustration that, you just wish it was going faster, you wish it was all done.
Have you ever had something that you don't want to go faster? And you don't want to be easier and you don't want it to have been done? I think I'm not sitting there going, I can't do something because it's not been done. But when it has been done, clearly things will be better.
Brilliant. Okay. Another really big thing that's been going on is ESG. And that looks to many like a very, very interesting opportunity. How are you going about this? Because it seems to be, it's going to be touching everything as far as I can see.
Absolutely. And, the importance for us has been sort of engaging with the staff, making sure we're doing what we as a business want to do. Our chairman is a member of the Green Party, so very much driving that from an Apollo perspective. It's all about doing the right thing. It's about doing the right thing and supporting the companies that are trying to do the right thing. But ESG isn't just about E, although that's getting a lot of focus at the moment. It's also about the S bit and, engaging with our staff and making sure they're comfortable with how we're doing it, and what we're doing is clearly paying dividends on that side too.
Yeah, how do you approach that balance, though, on energy, for example? It must be hard. And at some point, and also you're investing in all the sort of ESG scoring systems and things that are going to be coming in. Presumably, it's almost as if that's going to be on every line, isn't it?
I think assessing who are the good players and the bad players is a major challenge and going to be expensive.
And for a financial institution or something, you think, goodness, how are they going to get an ESG number when they've got millions of clients and different loan books in different parts of the world? It must be really hard.
It's not easy, but that doesn't mean we shouldn't be trying.
Yes, I suppose all the data is available, isn't it? Well, some of it is.
I think in varying levels of quality, and I think the challenge is, who's greenwashing, who's not greenwashing. No doubt we'll all make mistakes. I think at the end of the day, we'll reflect back on the things and say, did we make the decision using the data we had to try and do the right thing? And that's the core sort of judgment that we'll hold ourselves accountable to.
Obviously, there's an ESG sort of backed syndicate. You see interesting new source of capital. There's so much sort of green labelled capital out there. Do you not want to maybe harness some of that for your business? Obviously, you work with third-party capital.
I think the idea of an ESG-focused syndicate, definitely something of interest. We've got a lot on at the moment, so that's not plan A, but we definitely, in the SBS area, have been talking to someone that's very green-focused.
You can imagine, because, and also it seems to be much lower cost of capital at the moment. Obviously, the green stuff is sort of, almost zero cost of capital, isn't it?
It looks like that.
I mean, I'm sure it isn't in the long run. It just can't be. It's going to have to make a proper return, isn't it, over a long term. I wanted to ask you, in terms of how your personal investment and your career investment in Apollo, how do you look upon that as a business builder? Is it the sort of thing? There are some people who want to build a business forever and sort of leave it to their grandchildren, almost like their name above the door, not literally. Are you that sort of business? Or is there something in the back of your mind where you say, well, we're working to this plan, that we expect to be acquired at some point, or we've got no specific plan, but at some point someone will come with an offer we can't refuse and we'll become the specialty arm of some massive multinational or something?
I would say from a business perspective, because it almost feels like there are two questions there. One is personal and one is business.
Well, but it's your business. Well, you've got a lot invested in it.
I've got a lot invested in it, but I would say we've got an awful lot of people working here as well that have a lot invested in it. It's our business, not my business.
No, I understand that, yeah.
But I would say 61% of our employees are millennials. I know that's a wide band in terms of age range. I would say that last year or the year before and continues, we talk every year in terms of strategy review, and absolutely everyone is looking to build for the long term. So in terms of what type of business are we, I would say we are one that wants to keep building and keep building successfully. I think if we are successful, you retain the right to be independent. But as you get more successful, there inevitably will be more requirements for additional capital. But additional capital doesn't mean becoming the subsidiary of some major conglomerate that wants to tell you what to do. So I would say philosophically as a business, we want to grow, develop, and keep growing and develop and retaining the independence of management here. Personally, I will get to an age where someone else will be running the business.
Yeah, and I suppose sometimes if you're too busy growing, there's no way you're going to be thinking about, M&A. It doesn't sound...
The organic opportunities for us to grow definitely mean that we don't have to think about M&A.
I'd say in my experience as a financial journalist, the businesses that are going at 50 and 70% don't tend to be the ones that get acquired. They get invested in. And talking about investment, just forgive me, again, it's sort of Apollo 101 really sort of stuff. And a question I've never asked you is, you've got a relationship with Howden that's just under 10%, 9.9, under 9.9% shareholding from the Howden group there. When people ask you about that, what do you tell them? What's this relationship you've got with Howden? Particularly other brokers, obviously.
No, I understand. Actually, I don't think, apart from when they became a shareholder, I don't think I've been asked that question for many, many years now. But, if you did come and ask me that question, you were a broker, what would I say? Well, they're a great shareholder. They hold their shareholding independently to the broker business, because that's fundamentally the question you're asking. And we have a great relationship with them, but they do not interfere direct or sort of direct our business in any way that would give anyone any concern.
This is more of a strategic investment, obviously.
Yeah.
And obviously you've got another hat at Dual as well. So it's just, you obviously clearly got a good
We have a good relationship. And, I would hope we have a good relationship with other brokers too.
Well, David, I've really, really enjoyed talking to you. I think we could have just gone into all these subjects, a bit longer and deeper, but, clearly you're buzzing with energy, and I think it'll come across on this podcast to everyone listening. So I just want to thank you for giving up your time.
Thank you very much.
Thanks a lot.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this programme. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience, because you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry. The Voice of Insurance is produced in association with Advantage Go, enabling an enterprise view of exposure. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.